Hey traders, welcome back to the channel. Today, we're diving deep into something that's absolutely crucial for any trader's success: chart patterns. Think of them as the language of the market. If you can learn to read them, you're giving yourself a massive edge. So, grab a coffee, get comfortable, and let's unlock the secrets of these patterns together. First things first, what exactly are chart patterns? Simply put, they are recognizable formations of price movements on a chart. These patterns repeat over time across different markets and time frames, and they can give us clues about where the price might be headed next. They are formed by the collective actions of all market participants, buyers and sellers, and they represent the psychology of the market at a given time. There are two main categories of patterns: reversal patterns and continuation patterns. Reversal patterns, as the name suggests, signal that the current trend is likely to change direction. Continuation patterns suggest that the trend is just taking a breather and will likely continue on its current path. Understanding which is key to making informed trading decisions. Let's start with one of the most famous reversal patterns, the head and shoulders. Imagine a baseline, which we call the neckline. The price rallies up to a peak the left shoulder, pulls back to the neckline, rallies to an even higher peak the head, pulls back to the neckline again, and then rallies to a lower peak the right shoulder before breaking down through the neckline. This pattern, especially at the top of an uptrend, is a strong signal that the bulls are running out of steam and a bearish reversal might be on the horizon. A break below the neckline is your classic entry signal for a short position. Of course, there's also the inverse head and shoulders, which is just the upside-down version and signals a potential bullish reversal at the end of a downtrend. It's the same concept, just flipped. Spotting this at a market bottom can be a fantastic opportunity to go long. Another powerful reversal pattern is the double top and double bottom. A double top looks like the letter M. The price hits a resistance level, pulls back, and then hits that same resistance level again before falling. This shows that the buyers tried twice to break higher and failed, suggesting the sellers are taking control. Conversely, a double bottom looks like a W. The price finds support, bounces, comes back down to test that same support level, and then rallies. This is a bullish sign that the selling pressure is exhausted. Now, let's talk about continuation patterns. These are the patterns you look for when you are already in a trend and want to confirm if you should stay in the trade. The most common ones are flags and pennants. A flag looks like a small rectangular channel that slopes against the prevailing trend. For example, after a strong move up, you might see the price consolidate in a slight downward sloping channel before breaking out to the upside and continuing the rally. A pennant is similar, but instead of a channel, the consolidation looks like a small symmetrical triangle. Both of these patterns represent a brief pause where the market catches its breath before continuing its journey. Triangles are another major group of patterns that can be either reversal or continuation, depending on the context. You have ascending triangles, descending triangles, and symmetrical triangles. An ascending triangle has a flat top resistance and a rising bottom support, which is generally a bullish pattern. It shows buyers are becoming more aggressive, pushing the price up against a key resistance level, which is likely to break. A descending triangle is the opposite, with a flat bottom and a falling top, signaling bearish pressure. A symmetrical triangle has both a falling top and a rising bottom, indicating indecision. The breakout from a symmetrical triangle often dictates the next direction. So, how do you actually practice identifying these patterns? It's not about just memorizing pictures. The best way is through screen time. Open up your charting platform, go back in time on any asset, stocks, forex, crypto, it doesn't matter, and just start looking. Mark up your charts, look for potential head and shoulders, double tops, flags, and triangles. Then, move the chart forward to see what happened next. Did the pattern play out as expected? Why or why not? This exercise is invaluable. You'll start to develop a feel for the market's rhythm. You'll notice that no two patterns are ever perfect. They won't look exactly like the textbook diagrams. There will be noise and fake-outs. That's why context is everything. Always look at the bigger picture. Is the market in a strong uptrend or downtrend? What's the volume doing? A pattern with high volume on the breakout is much more reliable than one with weak volume. For instance, on a head and shoulders pattern, you typically want to see volume decreasing on the head and right shoulder, and then a big spike in volume when the price breaks the neckline. This confirms that conviction is behind the move. Another tip is to not force it. If you have to stare at a chart for 10 minutes and squint to see a pattern, it's probably not there. The best, most reliable patterns are the ones that jump out at you almost immediately. They should be clear and obvious. Let's recap the key steps to practice. 1. Learn the classic patterns: head and shoulders, double tops, bottoms, triangles, and flags. 2. Spend dedicated time reviewing historical charts. Mark them up, make predictions, and then see what actually happened. 3. Pay close attention to volume. Volume confirms the pattern. 4. Always consider the overall market trend and context. A bullish pattern in a strong downtrend is less likely to succeed. And 5. Start with paper trading. Practice entering and exiting trades based on these patterns without risking real money until you feel confident in your ability to spot them consistently. Mastering chart patterns isn't a shortcut to guaranteed profits. Trading always involves risk, but it is an essential skill that provides structure and logic to your trading decisions. It turns a chaotic-looking chart into a map of potential opportunities. It's about stacking the probabilities in your favor, one pattern at a time. The more you practice, the faster and more accurately you'll be able to identify these setups, and the more confident you'll become as a trader. That's all for today's deep dive. I hope this has given you a solid framework for practicing and mastering chart patterns. It takes patience and dedication, but I promise it's one of the most rewarding skills you can develop in your trading journey. If you found this video helpful, please hit that like button, and be sure to subscribe and turn on notifications so you don't miss our next video. Drop a comment below and let me know which chart pattern is your favorite to trade. Thanks for watching, and happy trading.